Hello, everybody, and welcome to the second session of the Political Economy Working Group for this year. Since I see many new faces, I would also like to briefly introduce myself. I'm Martin Fischer, second-year researcher here at the SPS department, and together with Jordi, who joins us online because he's currently in Paris, we are the coordinators of the working group for this year. And today it's our pleasure to host Professor Matthias Thiemann, who is an associate professor for European public policy at Sciences Po Paris. And as he describes himself, he's a sociologist with close affinities to political economy. So we are happy that you are here today in your fourth presentation for the week. And we are happy to hear your presentation, which has the title, In the Green Trenches, the EIB's Quest to Become EU's Climate Bank and its Evaluative Underpinnings. So this event is hybrid. We encourage also the online participants later to ask questions through the chat. Oh, wait, we have some more in the waiting room. And yes, and for whoever wants to ask questions or raise the word in the room, yeah, we would like you to use the microphone so that the online audience can also participate. So thank you, Matthias.
Yeah. Thank you very much. Thank you very much for coming, and thank you very much for having me. It's been an exciting week. It's also been a slightly exhausting week, so I hope that you bear with me. But don't worry. I hope, and I think it's still going to be some kind of fun when I'm going to talk today about how the EIB, the European Investment Bank, became EU's climate bank and its business underpinnings. This paper. So the first good news is the paper exists. There's a paper, so that's always why is that always an advantage for people who listen, because it's not completely loose, some kind of thinking that has been going on. But actually, I forced myself to sit down like last month and write the first draft of the paper, in which I'm trying to understand how the EIB, the European Investment Bank, took on this new role in 2019 and declared itself. Hello and hi. I can wait a second. Take him. And in 2019 declared that it's going to become Europe's climate bank. To start off the presentation today, I thought I'd start with a little game with you. Who am I? I am not a EU institution, but I am an EU body. So I am exempt from state aid. I am independent, but I'm bound to pursue EU community goals. I am owned by member states, but I'm increasingly implementing Commission policies, although member states own me. I'm known as risk averse, and basically, even to say the least, people deride me for being risk averse, but I also pride myself on my superior risk management capacities. I have 243 billion of subscribed capital, but only 21 billion are actually paid in. I have almost doubled my balance sheet size in terms of assets from 2007 to 2017. So I really had a great crisis, if you like. And my equity has grown at the same rate. I've actually almost doubled the number of employees. And I am doing more and more risky business, but I still have the highest equity ratio of large Western development banks. Who am I? I know. I am, of course, the European Investment Bank, and I have moved into this beautiful new building in 2012 because with all this growth going on, well, you know, I had to move over. And just to give you an example of how prominent I have become, when in 2012, Werner Hoyer becomes the new president of the EIB, you probably haven't read in the Financial Times about it. And if so, and I have to check this to make this a real anecdote, it was probably in a small article. Now it's for the last 3 months that we every week learn on who's running to become the new president of the European Investment Bank, currently with Nadia Calviño, the Spanish finance minister, the first in the running, but you know, she's running against Madame Vestager. And not only is she running against Madame Vestager, but also Dombrovsky, whom you also may have heard about, said at some point, well, if you can't agree who's going to run it, well, maybe I'm going to run it. So it's really become important for European politics who is running the European Investment Bank. And that is a bank that only 10 years ago was described as hidden in the woods of Luxembourg. So the EIB today surely is no longer hidden in the woods of Luxembourg. And so it's this bank. I've been working on this bank, I realize now, for about 10 years. And why is it so interesting to me? It's because of its hybridity. Okay, it is a bank, but it's also a policy tool. And it has it's thereby an addressee of a myriad of demands from different stakeholders. No, and also already for a bank, you know, shareholder value, if you're interested in this kind of stuff, you know how much of a struggle it was. But at some point in the 80s, there's this kind of like lock-in. This is what shareholder value is. This is what a bank should do and so on. But what about public banks? And these public banks have made a huge comeback in the last 15 years. And so I've started to ask myself, how are these banks actually held accountable? And how do these accountability relationships actually lead to what these banks are doing? And as one outcome of this, I've edited the book with two good colleagues of mine, with Daniel Mertens and Peter Volberding. And actually, I had the pleasure of presenting it here 2.5 years ago in the SPSPEWG, Political Economy Working Group. Everything back then was online. So maybe you haven't seen this book around, but this book has been published at Oxford University Press. And it's about the reinvention of development banking in the European Union. And what we did in that book was we tried to understand and theorize what has happened over the last, at that moment in time, basically from 2010 to 2020 in the European Union with development banks. And so we started with the observation that by 2017, pretty much every European Union country had a development bank, with 2 countries missing. That was Greece and that was Romania. And if I'm correctly informed, Romania still doesn't have a development bank, which is really annoying because I've been trying to write about that Romanian development bank for the last 5 years, and they can't agree, can't make up their mind to actually get one. This is the first, and if you're interested in that, we can get into that. The second observation that Gazas really started was that development banks expanded their balance sheet in total by more than 50%, reaching more than 2,000 billion euros in the European Union. Okay, so we started to be like, oh, these are really serious players and they're really important. And maybe many of you have heard about the Juncker plan. Yes, so the Juncker plan was the big time engagement of the European Union with these development banks, where they really started to be acting as a group of actors. Okay, so we identified this field, and Daniel and I would like to jokingly say, if you look, this is the egg. In the middle of it is really the core of the field of development banking. There's the European Investment Bank, with the European Investment Fund, which cooperates and competes with national development banks. I think that's why we chose the notion of the field. Okay, in a field is like bound together by common interest in development banking, but it's also a field riveted by competition. And what are these actors competing for? They're not only competing for legitimacy, they're also competing for funds from the European Union. And so we describe in this book how these people, how these actors come together and increasingly coordinate around implementing European public policy. And so the interesting aspect, as I said earlier, the European Commission increasingly draws on the European Investment Bank at least since 2000, if not since the 1980s. But it doesn't have a share, doesn't have a single share in the European Investment Bank. And so there's all this struggle, and the European Commission, in a sense, is somewhat unhappy about its incapacity to tell the EIB directly what it should do. And at the same time, it's happy not to have to put up any money and so on. Okay. So this is basically the field of European development banking by 2019. This is when I finished this book, and this is when COVID happened. Okay, so we finished this book, and this today is the first time I revisit the field. Okay, because what happened in the meantime, and that's what I want to focus on today, is that in September, Mr. Hoyer makes a big announcement. He speaks of a quantum leap. He says, by 2023, 50% of our financing will be green financing. Okay, and you have to know that the EIB has an annual production of credit of about 60 billion, so about 30 billion will be green, he announces, and thereby EIB becomes the largest green lender in Europe. And so when I read this initially, with Daniel together, we wrote already a chapter on this. There is an immediate implication, which is politicization. When the EIB goes out like this, it will make itself attackable for the attack of greenwashing. There is no way you can avoid this. It's just gonna, and in this sense, I asked myself, well, why does the EIB enter into the green trenches? Because we know that these actors, and in particular the EIB, like to avoid the spotlight. And so I asked myself these two questions, and that's what the paper is about. Question number one, why does the EIB enter into the green trenches? And question number two, what are the impact of this decision for EIB's business model? What you have to know, and I'll explain more about this, is that the EIB is known to be a highly risk-averse conservative institution. It doesn't like to take risk. It has the lowest non-performing loan ratio of all development banks, okay? And while if you do the green transition, you can do many things, but one thing is kind of certain, you'll have to take risk, okay? So there is a certain incompatibility between the EIB's risk business model before 2019 and this decision to take this kind of role. And so when we look at the literature, and today there is a literature about development banks, how and why development banks change over time, there's something that is very important that I want to convey to you. There's a great degree of skepticism. The literature basically says these actors talk a lot, but if they're not really forced to do things, they will, in a kind of principal-agent relationship, make it look as if they really do something, but then they don't really do too much. Okay, so there's this, often it's theorized as a principal-agent relationship. The principals are the shareholders, the stakeholders, like the member states. And basically, in this kind of worldview, what you would get or what you would expect is that the EIB says, oh, yes, I will do exactly what you want me to do. And then in the end, the EIB ends up what it always did. Okay, but it relabels the thing. This is kind of what emerges in the literature, for example, on the Juncker plan. In the Juncker plan, the EIB was asked to engage in increased risk-taking. And when you read, for example, the European Court of Auditors on the Juncker plan will say, we observe a certain degree of relabeling. So activities that you would have done anyway are now relabeled as high risk. And so there's this accusation of like not really living up to what they promised, okay? And so what we observe in this literature is this game where on the one hand, development banks are acutely aware of the need for legitimacy, okay? And because they need legitimacy, they go out there and they say, we will do what society asks us to do, okay? And yet, if they're not pushed, they will try to do it in a way that is really not hurting them, okay? That doesn't cut into their profits and so on. And so for me, this was my starting point. And I asked myself, but then under which conditions do we actually see them change? And I think in a certain public policy dynamic, we would want them to change, right? And it's a certain preview that I want to give you already. I think that the EIB has changed and that they are today increasingly engaging in risk-taking. And to me, this is basically the puzzle that I'm trying to solve in this paper. Why does the EIB not only get in the green trenches, but actually also increase their risk-taking? And so I think the first point to argue about this is to provide you with a little bit of context. Basically, this great growth strategy of the European Investment Bank that the EIB has run from 2000 onwards, has run into real trouble by 2017 onwards. There is a complicated relationship between the EIB and the European Commission, where the Commission is increasingly unhappy. Because, and this is from a paper by the EIB itself, where the EIB is extremely honest about it, the EIB is described as profit-driven, with the Commission having no capacity to steer what the EIB does, and with a lack of clear additionality. It's in essence, the European Commission has the feeling that they're paying too much and they're getting too little. They're getting too little change. And what's the effect of this? Well, there's a sudden, like, the European Commission surprises everyone, and in particular, the European Investment Bank, when in 2018, it announces that it will open the EU budget to other national development banks and the multilateral development bank. And so in a sense, suddenly, the EIB has to compete for these European budgetary funds, which before were what it was basing its growth on. In the end, the EIB manages to get 75% of the InvestEU fund, but still it's a warning shot. In 2018, with Brexit happening, the EIB has to ask for capital replenishment because, as in the EUI, also it's a problem for the EIB. So money is gone and the EIB has to ask for money. And in addition to that, two further things happen. There is a proposal to create a new EU climate bank that gains momentum in 2018 and 2019. And there's a debate on European development finance. So suddenly, the EIB finds itself questioned on all kinds of fronts. Okay? And it really has to fight for these European funds that it took for granted before. And so in the first answer that I want to provide to you today is, why does the EU enter into the EIB enter into the trenches? I think it's really an attempt to fend off institutional reform and secure legitimacy. So it's an attempt to prove to the EU that they are useful. And you can read this in all the speeches. It's like from 2019, it's a huge rebranding effort. It's, we are Europe's climate bank. Don't ask, don't look any further. Here we are, give us the money, we'll get the job done, right? And I could bombard you with these kind of like PR that the EIB does, but for the moment, I hope you'll take my word of it. But I think the question, the true question as a materialist that I am sometimes, and in this project I am, is to ask the question of resources. Because this will require substantial resources if you want to live up to the demand for climate mitigation. It will really cost money. And then I was really surprised when you look into EU mandate money does not go up. So the money that is provided by the European budget, by the EU Commission to the EIB does not go up, but it goes down by 35%. Okay? So if you hear these two things, claims like assumed role goes up, money given goes down, the first thing you think is organized hypocrisy, at least as an organizational sociologist. What is organized hypocrisy is exactly this. I will claim that I will do a lot of things, but de facto there will be very loose coupling, right? It's myth and ceremony. So, and I want to argue today that this is not the case. Instead, what we do observe is increased risk-taking by the European Investment Bank. Here on this slide, I've given you a little bit of the prehistory, so this doesn't come out of nowhere. The EIB is the first in 2007 to issue green bonds. It has already a 20% climate target in 2010. But really, in 2020, it suggests to double it. And it does so in a really fast in a fast pace from June 2019 to November 2019, and it's done. But what I think is even more important, that by November 2020, it adopts a climate bank roadmap in which it really commits itself to engage in increasing risk-taking. Okay, and so now what did we do in the paper? The second step, and this is a paper with Dan Mocano, I forgot to mention, is, that we do look at the numbers, okay? And so the first thing that we find, the EIB delivers. Okay, now, so what does it mean? First, it means that by 2022, more than 50% of the loans given by the European Investment Bank are deemed green according to their own metric. Now you may say, Matthias, but you're looking at the numbers provided by the organization. Good critique, fair critique. So let's go and dig a little bit deeper. Now, the second thing that we looked at, and here we were really, this is not so positive news. The EIB is currently in a phase in which it has not really expanded its lending. As you can see on this graph, I hope it's rather visible to you, the EIB's lending reaches a peak during the Eurozone crisis of 76 billion euros from 2014 to 2016. This is in the context of the Juncker plan. And then it goes down, and today it's only 65 billion. You're like, and I'm like, well, quantitatively speaking, the EIB doesn't do more. And that of course, I think is a big issue. What I've been told in my first interviews is that this has to be understood in the context of the transition. So Hoyer is ending his mandate, and they want to keep the powder dry for the new incoming president to be able to commit to a big project. Okay. And so, but here the data is not really fully convincing. Second piece of evidence, still not much to be seen here. What we do show you here is that, so what we checked is how's the EIB average loan, because credit mitigation for climate, it should be rather smaller loans. Loans on average do not get smaller, but the average loan size is 87 million, which is quite a lot. And then we looked at, in general, at EIB impaired loans. So this should be a sign of risk taking. We have come up to 0.4%, and I haven't put this up here in terms of comparison, but this is still 10 times smaller than what the EBRD would have, for example. So the European Bank for Reconstruction Development would be much more risky. So far, not much evidence. Then I need to, yes, million, yes. Yes, no, I apologize. Yes, it is million. Yes. So I'll fix this afterwards, but it is million. So the average loan that the EIB gives is 87 million. And that kind of makes sense because the EIB, where it comes from, it's an old big infrastructure bank, right? And infrastructure, I want to finance a highway, we're going to give you 200 million. But evidently, financing a highway doesn't really do climate mitigation, right? Now, here's the story in terms of empirics where we're at that I wanted to tell you. This is what piqued our interest. There is something that is called special risk activities in the EIB. And the EIB has developed special risk activities from 2009 onwards. These are small-sized loans where the EIB gives a loan to something that is not investment grade. So high-risk activity. And this is something the EIB didn't do before 2009. You can directly relate it to the engagement with the European Commission. It's more capital intensive, it's more staff intensive, it has higher additionality, and it's identified as seen as necessary to address climate change, the climate change mandate. And now what is striking us here is what you see on the right-hand side. This is like where it's going up. It's going to reach 11 billion. Well, if you believe the predictions of the future, but it has basically gone from 1 billion in 2016 to 6.3 billion. Like it has gone up 5 times, and it is supposed to go up in the future further. The interesting part about it is this is based on the own money of the EIB. So rather than taking the money of the European Commission, the EIB is here using their own money. And using that own money, they're putting it at greater risk because, as the next slide will show you, hopefully, the losses on special risk activities are 8%. There's some kids in the background. So, but it's about 8%, is to say, so this is really the risky activity that we would like the EIB to see. And not only is the EIB engaging in it, but it's engaging in it based on its own money. and not on the money of the European Commission. Now, this kind of contradicts pretty much everything we thought we know about the EIB. The EIB always likes to take the money of the European Commission. It doesn't like to take risk-taking. And here we see the EIB increasingly risk-taking and not taking the money of the European Commission. How can this be explained? And I think so. I don't want to make them out to be super good guys that are convinced that we have to save this planet, which would be great and might also be a part of the explanation. But I actually want to argue that this is a logical organizational response. Why? Because over the course of the last 15 years, the EIB has hired a lot of people that are highly capable and highly valued in the institution that do special risk activities. However, the European Commission has cut the money. So now they had basically two choices. They could either fire these people or they could use their own money, okay, to engage, increase their capacity. And I would call it not a ruse of history, but it's an interesting process of discovery. The EIB in 2020, and we're lucky we have these documents where they spell it out and we can even see their own surprise, has learned to make money with special risk activities. So they didn't, so in 2000, the EIB is a large infrastructure bank that on-lends and takes zero risk. In 2020, the EIB has become a bank that can deal with a 50 million euro loan that is non-investment graded, and it can make money out of it, or it can at least not lose money. I think that's the important point. Yeah. And so this is the moment, in a sense, where we see that they can actually expand in a business field without losing money, and they can project an image which answers the critics by the European Commission and by the Parliament. Okay? So the European Commission and the European Parliament keep saying, you're not risk-taking enough. You only care about the money. You don't give us what we want from you. And now, from 2020 onwards, the EIB goes on the counter-offensive and says, look at me. I'm going to give you what you're looking for. And I'm going to engage in this special risk-taking activity on my own account with my money, okay? And in this way, they can actually really answer this request for additionality. Now, the point, and I just want to make sure that you don't get me wrong, yes, and I'll be ending very soon. I want you to understand, for me, these are not, I mean, I think being convinced that climate change matters helps, and this is important. But I really think when you look at the growth of the EIB, the EIB has gone from 1,800 to 4,000 people by 2022. And it's an organization that usually doesn't let go of people. They don't let them, like, this is a public development bank. And so what they do, they want to keep their people, and therefore this is a strategy that is driven by the internal decision-making, in a sense, okay? So, conclusion takeaways. To my surprise, and I must be honest, I wasn't expecting this. I think the EIB substantially changes in the context of becoming Europe's climate bank. It's much bigger risk-taking linked to climate change activities. And I think what is interesting about it is that it's at the same time increasing the autonomy of the EIB, because it is no longer reliant on EU mandates, which it has found itself to be rather burdensome. And at the same time, it allows it to improve the legitimacy of the EIB in the eyes of relevant stakeholders, in particular the European Parliament. As you can probably feel from this presentation, I'm still somewhat at the beginning of the interview series. So because you haven't heard many quotes, or so we're still trying to dig this up. One argument that we're currently toying with is one could argue that this is forward-looking rational action. So it currently doesn't make sense to do it from a pure business perspective, but it's like trying to convince the principle that, hey, I can be the good guy. I can help you. And then going back to the EU and saying, now is the time to pay up. Yeah, but this, the future will show. And now I'm very much looking forward to your questions and comments. Thank you very much.
Thank you, Matthias, for the presentation. And I would suggest we have the questions in groups. So
let's see if we have any questions.
Let's see. I'm pretty sure. Yeah, starting with the room, and those who are, we also have questions in the chat. I will come to them then in the second round. Tobias.
Excellent. Thank you, Matthias. I mean, it's a really interesting story. I basically have lots of clarification questions, so they're kind of geeky. I mean, the first one is you had a slide on profit. And my question is this net income, or like, how do you do it, right? Because what you count as profit on a financial dealing is not so clear. So maybe just really specify what you mean. And then I would even compare what they book as, accounting profit versus cash profit, because there may be some very different things going on. The second, do you know what their definition of loan impairment is? Have they missed a covenant? Have they missed an interest payment? Are they no longer listing the loan as a market price on their books? Another question is, when they make these loans, is it really a loan to maturity strategy, or they're actually selling some of these in secondary markets? And then last, so you had a lot of quantity slides, but there's no interest rates. So I would be really interested in what they actually charge on these loans, right? Because if you have a non-performing loan of, 0.4%, and that goes up to 8% on your special risk activities, I mean, that's 20-fold. So I would be kind of interested just in a business perspective, are they actually doing it well? Because they should charge 20 times as much for those loans. And I'd be really interested to see, are they basically doing a good job?
Thank you very much for this very interesting presentation. I want to ask, to what extent does the EIB react to the discussion of the multilateral development banks and the reform discussions of those as regards, for instance, high-risk capital also for low-growth states and developing states, cooperation with the private sector, how to leverage their capital in that sense? What role does the EIB play in this context? And the other small question, to what extent, when now assessing their performance, green performance of the EIB in recent years, how does it speak to the indicators? Green indicates greening indicators of the Commission, which are available, right?
Want to answer now already, or yeah, because
yeah. Thank you very much for these questions, and I can see that there is an expert audience in the room, but these are very important questions. So the first thing in here, so as of right now, we're basing ourselves on a evaluation of special risk activities by the EIB, which is a 50-page report. We also have now data, but for now, I'm really basing myself on this. And so what does this report say? And this, I think, can clarify a few of the questions that you brought up. So this report says, by mid-2020, we have reached cost neutrality. And I think that's the most important statement in that report. So special risk activities have become cost neutral. And they are, and here that goes into your question, in the direction of your questions, and they are potentially profitable. Why is that important? Because evidently, if you give these loans now, you'll only know if they are profitable or not in 10 years, or however long the duration of your loan is. So I have to also find the duration of the loan, but I think we're definitely talking about several years. And so the second thing that they're observing is that the risk pricing is absolutely crucial, both to reaching the cost neutrality and also to the potential profitability. And here, I think what is interesting, the language is a little bit needs deciphering, but in the evaluation report, it speaks of a certain high demand in this market segment, which I think means basically that there are few lenders in Europe that are willing to engage lowly rated, like, or non-investment grade rated investments, loans, and so on to SMEs, which is not a big surprise. And the EIB finds itself that now it becomes a player. It has the expertise and it becomes competitive in this market. And it's exactly the interest rates 20 times. This sounds crazy, and I agree with you. And this is exactly in this new interest rate environment, a very interesting question. I think back in the day, 3 years ago, the EIB might have made an interest rate loan of 1%, or like, you know, and of course it will not have charged 20 times 1%, but it could have gone up to 4 or 5%, you know? The pricing is crucial, and they have asked for more money, but I think it will be a very interesting question to ask how this changes today with this new high interest rate. So this would be my first attempt at an answer. Thank you. The second question: to what extent does the EIB react to multilateral development banks in their debates? I think the EIB is very proactive in this realm. It's actually, you could argue, it is the avant-garde, if you want to use that word, or it's the forerunner in the field of multilateral development banks when it comes to greening their portfolio. And of course, they won't miss a moment to point that out. So they are on every panel. Hoyer will be on every panel, and he will speak to that, and he's going to push the others, and he's going to be like, well, we already achieved that. We already have 50% of our, that's in 2022. So, but they are usually making these commitments in the context of COP. So the big speech on the quantum leap, for example, is a speech given at a COP when Hoyer. So I think the context of multilateral development banks is crucial, and the EIB is trying to portray itself as really an advanced bank that is at the forefront of these developments. And I think there's an interesting overlap with the new role of global gateway with the EIB, where EIB gets to invest outside of Europe, and where it also portrays itself as the investor that will do all this green lending and so on. Like, you will see them like, we are going to finance solar cell production in Chile, or, you know, this kind of like self-portrayal. Now, you were asking also about the indicators. And I think this is a crucial question. The EIB did face some problems, in particular in the context of the debate over whether nuclear is green or not. So you were mentioning the European indicators for sustainable like investment that the European Commission has published, and it might be interesting for you to maybe you're already aware of this. One of the current big debates between Nadia Calvino and Madame Vestager is whether nuclear investment should be deemed green or not. And Macron initially opposed Vestager because Vestager opposed nuclear as green. So basically opposed the EIB financing nuclear, which has led Madame Vestager to show some degree of flexibility on the question of nuclear financing by the EIB, possibly opening the way even under Vestager to finance this. And so the EIB initially is actually more advanced than the green taxonomy. And this is a good question. I think there's a certain degree of backtracking once the taxonomy allows that. So once the taxonomy is decided, the EIB will move in line with the taxonomy, because its initial internal taxonomy was actually more advanced than the green taxonomy of the European Commission. It's not as clear as I would like it to be, but let me say that we are at the beginning of this project. Thank you.
Next, we have a comment, I think, in the chat, and if you would like to also speak it out, and we have a raised hand by Federica. So first Chris, and then Federica, and then we come back to the room.
Hello, everybody. Can you hear me? Can you hear me?
Yes.
Is that working?
Yes, it works.
Okay, great. Hi, I'm Chris Hurst. I'm with the School of Transnational Governance at the EIB, but in fact, from many years I worked at the European Investment Bank, And in fact, it's by chance from 2019 to 2022, I was actually one of the main authors of the Climate Bank roadmap that you've referred to. So I can give you a little bit of the insider view. Also, now not being inside, I can also maybe speak a bit freer than I would have been if I was inside. I think your analysis is right in very many respects. The one issue I have is I think it's a wrong indicator to think that risk-taking is the best indicator of the transition to climate lending, or being a good climate lender is through risk-taking per se. I mean, it may well be that taking more risk on some categories of projects means that those projects go ahead where they otherwise would not, and if the climate projects, so much the better. But it's not necessarily the case that the only way to do climate lending is through taking more risk. And an example would be, you've mentioned nuclear, but actually nuclear is not the difficult question. It's more the natural gas, and whether natural gas is a transition fuel. Natural gas lending for networks is not particularly risky. These are all large network companies. However, should you be doing that or not? Or should you be doing lending to utilities who are developing the electricity grid in order to better cope with the green transition and renewable energy, which is fed into the grid? That's also low risk lending. So the choice is not necessarily the only way I can do climate is by doing risk. There's a whole set of things you have to take into account, and the difficulty is that you mentioned the fact that the commission, the role of the commission with respect to the EIB, but the EIB has its own internal governance, including a board of directors, which are representatives of the finance ministries of the countries involved, and so those people reflect also their national view and reflect an EU view insofar as it's a compromise between the member states. So it's not that the EIB is off there and it's on its own trying to just protect its interests, and there's a commission out there who are the guys driving policy. You also have policy coming from the internal system, which has to be looked at, and is clearly there. You also get into all sorts of national compromises and conflicts and necessary to try to build a way through that, which is quite complicated. Now, I think you are right in saying that it was a look for legitimacy, and that was what was the main factor driving it at the political level. And again, if you look at an organization, there are multiple levels and multiple objectives by the different people at different levels of that organization. And at the higher levels, there's clearly a political goal for relevance, which people like Werner Hoyer was looking at. And at the staff level, people are looking probably more to protect themselves from political influence, to do things that are politically good and not necessarily economically sound. And so to look at defining the set of objectives that are around climate protects those staff members who are trying to pursue and create an organization which is technocratic. So it doesn't follow that these trade-offs that you had in one of your slides between looking for legitimacy and looking for independence are not necessarily taking place at the same levels of the organization. So you have to look at that dimension. So there was a strong desire for political legitimacy, and I think it happened in 2019, which was very fortunate, because had it happened a little bit later, it would have been a transition which would have been much more difficult. If it happened after the Russian invasion of Ukraine, when gas prices started getting very high, oil prices started getting very high, I think it would have been almost impossible at that moment in time to launch a strategy whereby you seem to be not addressing that question directly, but indirectly through supporting renewable energy. The question is, the bank makes a lot of money, and it makes a lot of money because it's sitting on a huge amount of equity, and those equities are invested in loans. and they generate this, the equity generates the same return as the loans do, which are the bank's borrowing rate plus margins, right? The margin, cost plus margin plus a risk margin, which is very small. So it makes a lot of its own money, which it can reinvest in lending, essentially, and that's what it does. It retains earnings and uses it to reinvest in its own business. But the amount of money that it's making means that the staff budget was not really a driver in deciding what. I mean, clearly there's concerns that the staff budget is growing all the time, and in particularly in a low interest environment, that the returns on equity are falling, and so there's an issue there to be worried about in the long term. But the short term objective was one which you said is in the aftermath of the financial crisis, there being a squeeze on the legitimacy of the organization, a squeeze coming from the Commission as well, which was driving the political level, saying, how do we go about making something? I realize I'm probably not giving a question, but talking too long. So perhaps I can.
But this is
happy,
great.
Happy, Matthias, to chat bilaterally to you, and to go through that in a bit more detail and bilaterally. Thanks.
Thank you very much.
Shall I ask my question now or after you have addressed these comments?
Please ask it now. We take two. Thank you.
Okay. Good evening. So I'm Federica. I think we met last week at your other presentation, but I work at the School of Banking and Finance. I do research on sustainable finance also, and I was particularly intrigued by the presentation and by this work because before joining the EUI, I was at EBRD, and I was also working in the legal transition team on policies in sustainable finance. And I also contributed to their Paris alignment methodology. So I really look forward to reading the final output and also the interviews. So actually, I had two questions, but perhaps you already addressed the first of them. So I was more curious about your opinion on their definition of green loans. I think you've partially addressed this, but so I was just curious to what extent you think this has also contributed to this also contributes to their quest for legitimacy. And the other one was also whether you've also thought of how a question of mandate has been a factor in their turn to a more climate-friendly policy, and especially because I've seen that there's now a widespread acknowledgement of climate change as being part of the mandate for other EU institutions. And for example, looking at the ECB, of course, the ECB has a very different role in the institutional architecture, but like 8 years ago, they were not very vocal about climate change being part of their mandate, and now they are. And like correspondingly, like mandate also calls for a question of litigation risk, because like, EIB has also been subject to litigation for their climate policies. So I don't know if this has also been part of your reflections or of your research. Thank you.
Thank you very much. These are really wonderful comments and questions. I'll start backward, maybe if I may, from Federica. It's one more slide I have. We are currently evaluating the evaluation of green loans in the EIB, but we haven't really, and now I don't show it to you anymore because no, but now you see it, no you don't. But the issue is I'm not yet fully able of telling you what I think about the green loan label, only that I currently think that it's not greenwashing. This is
already an interesting result though.
yeah, but I mean, in the sense of like we observed the standards that they're applying, and we observed we try to look at NGOs that observe their actions, and there have been all kind of allegations regarding the EIB, including that they're not super transparent, and including that sometimes they are supporting corruption. These are current allegations against the EIB, but as of today, there is little in terms of, oh, you are greenwashing your loans. I think there's also a certain degree of intransparency. So I don't want to completely absolve the EIB, both in terms of the way that they deal with the question of transparency, but also with respect to their green loans. In particular, Dan Mokano, who's a doctoral student in Oxford and my co-author on this paper, has attended a conference of the EIB on the roadmap, where participants actually complained about the transparency. We have gotten our hands a little bit on more internal data of the EIB, where we want to look at what they claim to be climate related. We found their work as of today. My thinking about this work is that it shows a real degree of commitment, and a degree of commitment by the organization that has expressed itself in terms of taxonomies, which seem both usable and rather exigent or demanding. So we've tried to contact the evaluation team at the EIB. We've been informed that the evaluation team at the EIB is currently evaluating the climate bank roadmap, that they will publish their results in 2024, and that they don't have time to talk with us. And that makes sense. So so what I can then say to you, and I'm curious to learn more about the EBRD, is that we're at the beginning of this investigation. We're looking at their standards and metrics, but we haven't yet produced any meaningful final results. So that would be my answer to that comment. And so I think it's a very important question, and our future work has to cover it. The second reaction to the comment, I think the first thing, yes, the EIB is a member state bank, and so there are all sorts of national compromises and conflicts that go into the stance of the EIB as a climate bank. And we've been told that it actually took quite a lot of convincing to push for this climate bank decision for the member states to go along. We, however, do have a problem in terms of empirics. These kind of conflicts are not necessarily, they are not played out in public, and you don't get, I mean, you know, if ever of you reads the board minutes of the EIB, they're not exactly detailing this kind of conflict. So I think with some guidance from interviews, we will be able to reconstruct some of these conflicts, but we really noticed that it's rather difficult to pierce the veil really here. So I do take these comments, and I do take them very seriously. I don't know yet how we can do more justice to the role of member states in this transition, because I think that's really important. The second thing, I think you mentioned it very nicely, the EIB does make quite a lot of money, and the EIB does have quite a lot of money on the side. It's called reserves. And there are like 65 billion euros of reserves on the EIB's balance sheet, which is money made in the past. Like, and I think it's a big question if and where this money will go and who will use it. I find it very interesting. You mentioned the Ukraine war and so on. There's currently a lot of negotiations going on about the role of the EIB in the reconstruction of Ukraine. So all of these things cannot be fully spelled out right now. I think what is important to me, and why I started this project, and I'll stop commenting on a comment here, but what got me started in this project was interviews in 2019, 2020 in Luxembourg, where people who were working at the EIB kept telling me something that I could sum up like this: the EIB is really an interesting and a good tool, but it could do so much more if it was just pushed more. So people who are working at the EIB and who were observing how this is an institution that can do a lot in terms of policy leverage and getting a lot of things done for the European Union, and at the same time a conservative institution that doesn't really want to get out of its comfort zone. And so I'm looking at these changes in the last 4 years, and I'm trying to square these two things. And one option is that I was just talking with kind of the guys, maybe like you, Chris, that were pushing the EIB along towards a new stance. But then at the same time, I'm not an idealist who just believes in agency. right? So what's the context conditions that lead the EIB to change? And so yeah, thank you very much. It was a great comment, and I'm looking forward to exchange maybe with both of you in the future on these topics. Thank you.
Thank you so much.
So we had 2 questions in the room. First from you, sorry, I don't know your name, and then from Eric.
Yes.
Could you use the microphone?
Very good evening. Many thanks for this very interesting presentation. Allow me also to offer a few comments and questions, definitely. I think along three dimensions. First, on the relationship with the European Commission, and the control and the deficit that you mentioned there. Second, the question of risk, a bit following up on the Chris Hurst's comment there. And third, also on EIB Global. So first on the European Commission collaboration, control or lack thereof. There's, of course, 2 levels. Key one on the policy side, and you are focusing on the climate bank roadmap here, but also very relevant, for example, the energy lending policy, the transport lending policy, which include then not disconnected, but very closely related and complementary, more specific requirements. And then on the other hand, besides the policy level, the project level. So there are the EIB statutes, the Article 19, which mandates that every single operation above 50 million have to be signed off by the Directorates General of the European Commission, and thereby the Commission as a whole. And at this point, I should mention maybe I am the technocrat responsible in DG Climate Action of the Commission that deals with every single one of these Article 19 requests, as well as the policy level. So I'm kind of the EIB desk in for my DG there. And first on the policy level, indeed, there is now this midterm review of the CBR, and there, yeah, I don't think you will be surprised to hear, and I don't think I'm revealing any secrets that I'm bound to in my professional function, which is very strict in general, as you can imagine, and not to reveal anything publicly, but it's generally on track. And will be some fine-tuning, probably you know as much already, keeping up with some policy developments in the meantime. And of course, they're also very interesting and I think very positive. So maybe to complement your picture that you drew, I think very accurately on this tension, this relationship, but also to say that there's actually excellent collaboration, also specifically between the EIB and DG Klima regarding, for instance, the rollout of the InvestEU program that you mentioned, the InvestEU Advisory Hub, the guarantees that are provided there, also the Just Transition Fund and others. And on the concrete operation level, the project level, this Article 19 process, I was wondering if you have any comments, any views on that, because in a way, of course, it's very early in the project cycle before the proper project appraisal. So many questions that I would ask for certain projects wouldn't be able to be answered yet. They say, no, it's too early to say that. But at the same time, it's also quite late within the project cycle, in the sense that the basic decision to pursue such a project has been undertaken already by the bank. And of course, it's not carved in stone, but it takes an effort, let's put it like that, from the Commission to stop then an activity. And there's a very formal process there, of course. So not to be overly extensive on this, but yeah, really a question on also this Article 19 process, if you have anything, any reflections there. And second, on the risk side, I think that's very interesting because it's indeed something that in general terms, I can definitely confirm from the Commission side, we are interested in the EIB taking on more risk, but not for the sake of risk itself, but it's a question of risk and return always. And specifically, the keyword for me is additionality, because it's not just another commercial bank, it's not just another investor, but it needs to fill a gap that others won't fill. That's why it's a public bank pursuing public policy objectives. And this is very hard to assess. And I've been reminded also in the Article 19 process, for instance, that it's not the question at hand whether the project is additional, but whether it is policy aligned, whether the EIB isn't departing from a Commission, from EU policies. So this question of additionality of projects, so is it crowding in a private investment by third parties, private parties, rather than crowding it out? And that's something I struggle with. So any reflections from your side would be very valuable. And to get a slight bit more specific there, you say from your metrics, which I'm not sure, honestly, I fully grasped them, but if you wouldn't mind sharing your presentation, or we can have a follow-up at some point, would be great. But if I look, for example, many of these projects crossing my desk are indeed renewable energy projects, and these are then 100% contributing to climate action and environmental sustainability objective, the 50%. And there, well, I'm speaking for myself personally now, is really a greenfield, mature wind, solar PV project onshore. Is that really risky? Is that not something that the private sector should do? Wouldn't it be risk-taking to invest into that crazy startup that needs those billions to scale up their really cutting edge, but risky new renewable technology, offshore, tidal power, and so on? Of course, part of the context, and a colleague online mentioned the crises, the energy crisis. Part of the context is REPowerEU, whereby the own financing share of the EIB was increased to 75%, whereas usually it's 50% only. So to roll out these projects more quickly and help achieve in the very short term energy independence for the EU, which is the order of the day, needless to say. And also related to that, the path framework, which is in short how the EIB gets or tries to green counterparties beyond the specific project in question. So they look at the bank which they're financing, or the project promoter. And so here there's been interesting, in the context of REPowerEU, an interesting further flexibility, which is to invest in fossil fuel majors, because these are also these days the renewables majors, even though it's still a comparatively small share of their activities, but they are of course much bigger than renewables pure players. And is that risk taking, or is that rather playing it safe in order to deploy quickly with proven stable parties, even if, and I don't have to cite the evidence there, the trillions that have been invested by these players against the Paris Agreement, since the Paris Agreement, and fungibility of capital provided, of course, also enabling them to pursue their core business model based on fossil fuels. So there are some question marks there, but this is, of course, the messy real world. And we can't exactly choose who we negotiate with at COP28 or who we get to deploy these renewables projects. But it is, I think, an important question. And my last sub-comment on part 2 on risk, the targets, you showed the targets, and the 50% target was for 2025, and they have reached it last year. So was it ambitious enough? Would they have been able to be on track for that target, but not reach it yet, but reach it when they wanted to by taking more risk? Questions. And third, on EIB's global activities, I think it's very interesting and telling and related to your question here, my neighbor, on the ambition to become a fully fledged development bank with this establishment of EIB Global as a new branch last year, I believe, or 2 years ago. EIB Global proper, with overall 10% of overall, I think, financing going to third countries, and the ambition to scale that up. And then there, when looking myself at EIB Global projects, the additional difficulty of assess the policy coherence, to do the policy check that I have to do, because while the taxonomy, the EU taxonomy, is one of the guiding instruments there to check whether they're aligned in third countries. Of course, it's difficult to apply, if not impossible, the EU taxonomy one-to-one, because it references, for instance, EU policies, and it is more difficult, and hence the difficulty of assessing whether the greenness is really as ambitious as it should be when it concerns fossil fuel related projects that the bank still pursues in third countries, such as non-electric rail, or also certain road projects. So yeah, I think there it's even more interesting because, of course, in terms of fulfilling the EU's climate targets, the most important aspect is what the rest of the world does, and we may be sure that it's possible to do it, but we are not even 8% of global greenhouse gas emissions, of course, at this point. So thanks for your patience when I rolled out these reflections and comments, but to conclude with a big thanks and really interesting research, and would be interesting to follow up definitely, because of course by definition the science policy interface is always deficient.
Thank you.
We want to connect the second one, or microphone. Sorry.
Well, Eric, it depends a little bit how big your comment is. If it's of the same size, then I should probably answer, because there's no. Yeah, so I'll try. I mean, it was a lot, and as you could see, I took a lot of notes because I think they're all very important points. Now, you mentioned the I think Article 19, EIB Article 19, everything that is above 50 million has to go over your desk in the case of DG Climate. And that is indeed the crucial element that currently links the EIB and the European Commission. And I will take a little liberty with your comment, if I may, which is something that I didn't have the time to mention in my presentation, which is from 2019 onwards, there's an interesting dynamic between three actors: the European Parliament, the European Investment Bank, and the European Commission. And that interesting development is the following. The European Parliament actually starts to love the EIB. Like, oh, they're more risk-taking, it's good, we need to support them. No? And then they say, we think the European Commission should take an equity stake in the European Investment Bank. also they say, and that's the researcher part of me that says, yes, please, they say the European Parliament says, because we need more transparency and we need more accountability for where the European money goes, but we don't get it because we could get it, they say, if the European Commission would take an equity stake. And in response, what does the European Commission say? The European Commission says, we have assessed the situation and we're of the opinion that the European Investment Bank has enough money as it is. They don't need our money, and we just need to tweak a little bit the mandate, which they did, and then that's fine. And so this is not to be sneaky or, you know, cheeky, because, you know, I'm just a researcher, and I understand that it's a lot of money also that is at stake here. It's just to say that this debate has been going on for a long time, actually, already from the 2000s onwards, whether the European Commission should take an equity stake in the EIB or not. And I know it's a lot of money, so the question would be, okay, where does the money come from? And I agree with that. But I think in bigger picture question here is, and that was, I would relay a different question to you. Could it maybe not be more efficient for the European Commission to achieve its goals with the EIB if it were to take an equity stake? I know, I've taken a question and transformed it into another question, which is not very fair. And so I agree with that. The only way that I encountered the Article 19 in my investigations of the EIB until today was that the European Commission is exerting a kind of veto here, because it can also, in theory, veto what comes on its desk. It could say it's not aligned and so on. So there is the EIB, the European Commission is exerting influence on the EIB through this. And I think the only thing that I would suggest, and probably I'm not the right person to do it, but is to have a look at this particular governance arrangement and what it makes possible and what it makes not possible, and compare that to what would be the situation if the EIB would get now it's going to be a big number. Let's say the European Commission pays in $1 billion or 2 billion into the European Investment Bank. Of course, where would that money come from is a different, yeah. So, but it's a question that I would like to pose back, because I think it's something that I encountered in the interviews and that I encountered with the European Parliament, and now I'm like, would that actually fix anything or not? Other than that, I think the issues that you have mentioned, for example, invest in fossil fuel majors and so on. What interests me in high special risk activities is that they're supposedly exactly this kind of like quasi-equity investment, equity investment in SMEs that are supposed to be on the verge of a breakthrough or need money to go on in there. And I think it's there where we need to focus very attentively on what is going on. There's also a question of the European Investment Fund, right, the EIF, and the European Investment Bank. From my interviews with people in the bank, the observation is the following. The people in the European Investment Bank are closer to policy. The people in the European Investment Fund are closer to the markets. So I would expect the people in the European Investment Bank to be more able to take policy relevant decisions. So I think it's currently rightly placed in the EIB and not in the EIF. My follow-up question would be based on a case that I studied for the KfW. The KfW has PhDs in physics who evaluated early on the wind turbine projects. So when the KfW invested in wind turbine projects, they signaled to everyone, this is a viable project, because we, the KfW, are not only bankers, we also know what it takes to make a viable windmill project. My question back to you and actually to the EIB would be, in how far is the EIB today capable of playing this lead investor, or in French we say phare, Leuchtturm, yes, sorry? Lighthouse investor. So the one that says, this is the way to go, because we at the EIB are capable of telling you that these particular windmills that you mentioned on the sea are viable or not. And I think so. The question is a question of expertise and capabilities. And I would actually be as interested or more interested in asking you how you organize this expertise discussion on what is actually a meaningful thing to invest in. I think in general, we're about to publish a special issue on what we call the European investor state. And that's where these questions come up. If you invest public money for public purpose, how do you do it in a good way? And I think we're just coming out of neoliberalism, if I may, and it's a big word and whatever, but we're asking questions today that we didn't ask for a long time, which is like how to improve on the market. Et voilà. Et voilà. So this is the questions of the day. Thank you.
Matthias, thank you so much for doing this. I mean, you know, of course, that we have an EIB climate chair at the School of Transnational Governance. So this is a subject near and dear to our institutional hearts. As I was listening to you, I was trying to understand what assets the EIB is booking in this climate space, right? In particular, as I was listening to our colleague from the European Commission, I was trying to understand how they're structuring these assets in order to achieve additionality, and in structuring the assets to achieve additionality, how they're assessing the risk. So while you were talking, and please forgive me, I was looking at my phone because I was reading bits of the financial report for 2022. And what the financial report states, I think, is really interesting. In 2022, they booked out 8.4 billion in loans that they would consider in their high risk category, compared to 2.7 billion that were in their high risk category in 2021. Over the same period, they deployed 24.8 billion in guarantee support under the Pan-European Guarantee Scheme. So these guarantees are not counted in their high risk category. So I'm wondering how you actually throw a guarantee out there on private sector investment, and that's not considered high risk. And equally, if it's not, then to what extent is what we're seeing really just the de-risking that Daniela Gabor has been telling us to look for in all this climate action? So it's not that they are taking on more risk because they want to get into this climate space. They're taking on more risk because the instruments they have to use to have any real impact in this climate space are instruments that are necessarily more risky because of the high degree of additionality that they're required to achieve.
That's a very concise comment. It's a great comment. So I'll give some tentative answers, and I think it's so what we've been struck by for now, and so we do have data, but we didn't yet have the time to analyze the data. But what we've been struck by among these 8.4 billion euros in loans, and here's where the numbers matter, but I don't yet have the composition. But so verbally, what the EIB emphasizes is quasi-equity debt investment, equity investments, venture capital investments, and so on, which is in essence small loans given to actors when you cannot even put a probability on it, or it's very like everything we know about why commercial banking got out of SMEs, right? You can't put an easy Basel thing on it, so these kind of things. And so I think actually, if I'm correct, and there is, of course, we are really in the real problem for a researcher here is that this is highly contested political economy terrain. So all the actors have a stake in making this look in a particular way, right? But if the story of special risk activities turns out to hold in-depth quantitative and qualitative investigation that we've just begun, then this is not the de-risking that Daniela Gabor is rightly worried about. Why? Because in essence, we're not dealing with complicated special purpose vehicles, tranching, securitization, and all of it, but we're really dealing with one-on-one engagement with smaller entities that that imply direct risk taking. So nobody is de-risked. It's more like there is an agent, supposedly an SME, that does stuff in the climate space that supposedly can't get access to reliable and cheap funding, and therefore turns to the EIB. It does sound like the EIB playbook, so that's where I mean, like, I have a problem here, because the actor that I'm investigating evidently has a high interest in framing this in this particular way. Now, the second element to your question is, in a sense, so you're asking about additionality. What struck us and what we found interesting is that the EIB has changed the way that it measures additionality in 2021, because it has published a framework that it calls the Additionality and Impact Measurement Framework. And what is interesting about this is, and here again, the proof of the pudding is in the eating, but at least on paper, the EIB disemphasizes simple financial metrics of return on loan and so on, like everything that they kept looking at during the Juncker plan, and everything that the European Commission really got upset about, because we're like, for us, you're not a bank. For us, you are a public policy tool. So we want to know what you're doing other than finance, right? And so now they measure the sustainability part, they measure employment generated and so on. And yet, and this is where this project gets very sociological, and where I hope we have a long breath and also find some meaningful funding, is to ask these the in-house evaluators how you come up with these numbers. So we are discovering a profession, the profession of evaluators that operate in-house, that do this ex ante, in vivo, and ex post. And again, you cannot only interview these people, because these people also will tell you that they're super important. And there's a tendency of every actor that you're going to interview in this to inflate its own role, and so we need to find a good mixed method in order to answer your questions on this, to answer these questions correctly. And it's an interesting dance, because it involves both engaging these actors and getting access, and at the same time not being misled and being like led on the. So I'll be happy to exchange on this as this project evolves, because it's an interesting but difficult challenge. Thanks.
So Eric, I think you had a follow-up question, and do we have other questions? Yes, then I would say these are the last two questions for today.
Just real quick, Matthias, just to be clear, I mean, the EIB has many measures of additionality, but one of the things that it mentions in its financial report a couple of times is the amount of private capital it can leverage with the investments that it makes. In that form of additionality, I think, is where Daniela and I are both concerned. In that context, if the EIB is booking assets that put it below normal creditors on the creditor ladder in the case of repayment, then it can leverage that private capital, simply because it's by putting itself below them on the creditor ladder, it's effectively de-risking their position. So private capital floods in, and everybody is happy. You see what I mean?
No, yes, I do see what you mean. It's just that this particular element that I'm looking at, the high special risk activities, let's exchange on this in a few months. Let me say it like this, because in their verbal presentation, they never mention, oh, we take the first loss tranche, or this is what we're doing. The way that they present it is, we provide a loan that can be transformed into equity in case the company cannot repay. And so the de-risking is the de-risking of the SME and not the de-risking of the private financial investor. Now, of course, money is fungible. Maybe you're de-risking somebody else as you are yourself taking the risk. So look, my personal thinking about this is the following, and this is a bigger accountability issue. I think we have to fundamentally rethink the way that we analyze these agents and the accountability relationships that they have, because we don't want them just to make money, right? We want them to deliver additionality and all these kind of things. but all these kind of things are not provided by market auditors. Like auditors never go in and say, I mean, the corporate social responsibility guys go in, but who gives a, and do we think that corporate social responsibility measures of contributions of companies are really reliable or up to task? I don't think they are. I think we need to, what I'm trying to say here is we need to really also rethink trade-offs where we say, okay, maybe the EIB is loss-making on this point in terms of finance, but it gains so much in terms of these other, and it's not a call to arms, but it's a need for more engagement by more people that care about this in a way that people have cared about shareholder value metrics and shareholder everything from the 80s onwards. It's just that the question is why would anybody do this? Yeah, like how could this process be coming about where we keep having these conversations and then we keep saying, oh, but this is not good or this is good because we think this is, this is it. The debate needs to go even further than where it is right now, and I hope that we can go there.
So we have about 5 minutes, so we have one last question and yeah, answer.
So I'll make it quick. I also liked some of the questions that were pointing to the member states part on this, because I think that like development banks are back in the whole world. So this points a question for you, because if you give this kind of institutional explanation that comes from the EIB itself, it doesn't explain all of the other cases. And I think that part of the answer is because some of the policies that they are prone to do, that they are able to do, are coming back. So like sectoral allocation, and also what you're calling here additionality is something that the development banks were used to do, but then they started doing only horizontal credit lending. And I think kind of from your explanation, what I get here is that since the commission didn't want to lend more money to the EIB had somehow to enter in this wave, this world wave. And then the only way it could have done is using its retained earnings and its own funds, and then like take this opportunity somehow. And I think like this idea of the opportunity, that it's something that is missing in this narrative.
Yeah, so opportunity was, thank you very much. Opportunity was mentioned several times. I think I first of all, I want to thank also Chris' contribution when he said, if the move towards the climate bank had happened, like to appreciate the particular window of opportunity and the historical process of it getting launched in 2019. And not in 2020 and not in 2022, but in 2019, which I think is also what many researchers that do research on green central banking should appreciate or could appreciate, because it's in a particular historical window. I think the thing about opportunity, and here I haven't been clear enough, the literature on the reinvention of the EIB is actually full of examples when the EIB is facing a business problem and then reinvents itself because it has a business problem, not a policy problem, but a business problem, which is relating to this opportunity and it's relating to the hybrid nature of development banks as both banks and public policy tools, right? So to give you an example, in the 2000s, the large volume lending for the EIB gets a little bit smaller because you suddenly have the euro. What does the EIB do? The EIB reinvents itself as the public-private partnership expert. It hasn't been the expert before, and then in the 90s, in the late 90s, early 2000s, it pushes for it because it says, this is how we justify ourselves, but also this is how we'll make money. Now, I think with high-risk special activities, something similar is going on. I think it's, if I read, and this is where I am like, I want to sound a note of caution, but if I read the evaluation report correctly on special risk activities, what I am reading is almost somebody saying, look, we found this segment of the market that we weren't able to act before. Now the European Commission has given us a 10-year-long push into this realm. Now we have the expertise, and now we learn how to make money. We are a bank. So let's go and make special risk activities that help us to address climate change and make money. Because that's the, I mean, this is between the lines, but it's in the report, you know? And what I'm trying to understand, and again, this goes back to different actors pushing for different interests. This evaluation report on special risk activities is evidently also a political tool in a struggle over the soul of the EIB. So what's the future of the EIB? And there are certain people that are pushing for more special risk activities. Is it because they believe in the business case? Is it because they believe in the policy case? Is it because they believe in both? That's where we need to get the interviews probably, or some other kind of way of getting at this. But I think pointing out the opportunities that are involved in this is really important. The member states, for the moment, I am where I am and I do what I do, but we're trying to get at it. I have to figure this out, how to get the member states role, but it's a bit difficult. Yeah. Thank you. Mille grazie. Mille grazie.
So thanks again for everybody who participated today, and a special thank you to our guest, Matthias Thiemann. Yeah, I think we can.